In this video, we're going to start to look at financial markets and how these financial markets are behind quantitative easing. So the whole video is about quantitative easing and how that actually works within the economy. But actually, before we get to that, we need to think about these financial markets. Now, it looks a complicated picture, but basically you've got this blue box here is the government, and they do some spending and they get some income coming in taxes. You've got individuals within the economy, okay, Mr. Purple, Mrs. Green. You've got Mr. White, who's got some spare cash. You've got businesses, and you've got retail sector. You've got the Tesco's and Sainsbury's. But all of these individuals here, okay, have to have a bank account, because if Mr. Purple bought something from Mrs. Green, Mr. Purple has a bank here. He'll press the button on his phone nowadays, and the money will whiz over to the bank of Mrs. Green, and she'll say, "Oh, I've got some money, thank you very much, and now I'll sell you my bike." If you buy something in Tesco, you press the button and money leaves your account and ends up in the bank that Tesco bank with. Okay, and that's basically how the financial system works. But the bank, so the government here, do not have any accounts at these banks. Instead, the government has an account at the Bank of England. So this here is the Bank of England, and there's only two different institutions that can have an account at the Bank of England. Number one, the central government, and number two, the individual commercial banks. Okay, so that's the Barclays and the NatWest and HSBC, etc. Now, the Bank of England is actually owned by the government. It's a public sector company. It was nationalised in 1944, but they are independent of the government. So the government have an account with them, but they make decisions about interest rates on their own, and they have to, as you should know by now, have to try and keep inflation at 2% plus or minus 1%. Okay, so that's how it works. So when, as I say, Mr. Purple bought something from Mrs. Green, what happens is he presses the button, the money goes to their bank, and behind the scenes, in the Bank of England, this bank and this bank simply swap money over. So in this case, Mr. Purple paid Mrs. Green, and so the money is swapped between those banks, and it's all happening instantaneously at the press of a button. If, for example, I was Mr. Purple and I had to pay some taxes to the government, I would click a button, it would go to the government, and what would happen is in my bank, their balance would go down and the government's balance would go up. Okay. Now, one key thing is that each of these institutions, these commercial banks, as well as the government, cannot be overdrawn at the Bank of England. Okay, but it's just think of it, they have accounts at the Bank of England. So that's how it works. Now, let's get into the issuing of gilts, and then we'll get into, well, how does that then affect quantitative easing? So you will know that in the government they do some spending and they do some taxing. So what tends to happen is, in the UK and particularly most countries, the amount they spend is bigger than the amount that they tax. So therefore they've got to try and fund that. And how they fund that, okay, they add it up and they say, oh, wait a minute, we need a bit of money, and they issue what is known as a gilt. A gilt is simply a piece of paper. Think of it that way, and it's an IOU. It says to whoever buys it, we, the government of the UK, this government here, we will pay you back after it is redeemed. It's normally 20-25 years before the person with a piece of paper can get their money back from the government, although once they sell it, if they buy it rather, they can sell it in what they call a secondary market, and then every year they get a small amount of interest on it. Okay, so for example, if they have to issue this number of gilts, what will happen is maybe a bank will buy it, bank will say, well, we've got some spare cash, so we will buy your gilt from you, government. And in this sector here, in the Bank of England, the government has spent too much compared to its income, and so the bank will pay, this bank here, will pay money into the government account, and therefore that funds this excess spending which we see over here, because otherwise that would go into an overdraft, and that's not allowed. Okay, so that's basically how a deficit, a fiscal deficit, is funded. Okay, now you can then think, well, you have this idea, if you like, that whenever the government have the excess spending, okay, they have to issue lots of gilts. Now, who gets the gilts? Well, some go to banks, some might go to these investment funds here, and some might go to pension funds. So within the financial institutions, banks, commercial banks, pension funds, investment funds, they simply might hold these gilts, this piece of paper, as an asset instead of holding cash. And the cash over here has gone into the government account, which has funded their excess spending on their fiscal deficit. Okay, so that's the background to where these gilts came from. They came from excess spending by the government in time past. That's not quantitative easing. So what is quantitative easing? Well, what quantitative easing is that after the financial crash, for example, in 2008, and certainly through COVID, the banking system, banks, pension funds and investment funds, but certainly the banks, the commercial banks, were running out of money. They were what they call illiquid. They didn't have cash. They got these gilts, but they didn't have cash. And the interest rate had gone right down in the economy, but it wasn't low enough, and it couldn't go any lower, but it hadn't stimulated an increase in the banks lending out money because they weren't able to. They were illiquid. They didn't have the cash in order to lend to people, in order to increase spending in the economy and cause inflation to rise, because inflation had gone below the 2% plus or minus 1%. That's the key. It's gone below it, and they wanted inflation to rise. They wanted to increase spending. With the COVID and lockdown, they wanted the banks to keep lending money to firms to keep them afloat. Okay, so what they did is, you see the gilts here, the Bank of England said, we will buy the gilt. So the gilt has moved from here to here. This is not the government buying it, it's the Bank of England buying it. And they have a creation then of this digital money. So the Bank of England simply, like you and I do, pressed the button, and they gave digital money, an increase in money to the banks in exchange for the gilt, and that digital money finds its way over here into the commercial banks, and now these commercial banks have more liquidity. So all that's happened, as I say, the gilt has gone to the Bank of England. Bank of England have pressed a button. Money has been created digitally, not an increase in the actual physical amount of money, just digital creation of money. And that money has gone over to the commercial banks, and that has increased their liquidity. And so that's a really important thing that you've got to say when you look at quantitative easing, that there's three effects which we're going to look at. And the first one is it increases the liquidity of the banks. So that's the first effect. We'll come back to that, and I'll summarize this as well. The second effect is what effect it has on the interest rate in the economy. And you've got to then think, how does a gilt actually work? Well, here is your piece of paper, okay? So the government in times past need to borrow money from people, banks, pension funds, etc. And they will issue this piece of paper. And they will basically say on this piece of paper called a gilt, because it's as good as gold, it's like an IOU, okay? You can bring it back at some date in the future. This one, I've just made it up, 2040, and you will get £100 for that piece of paper. And in the meantime, we're going to pay you 5% on its price of £100. So you will get in 2040 £100, and in the meantime we're paying you 5% of £100. Okay, and that's important because they are paying you £5 per annum. So that is known as the coupon rate. You will get, whoever owns that piece of paper gets £5 every year from holding that piece of paper. Okay, now the price of that will go up and down in the market, as you're going to see in a minute, but whatever happens to the price, it only will give you 5%. £5. Okay, all right, that's important. So let's have a look at how that works. And what you've got to think about is this, that people who've got some money to invest could buy some of those gilts, could put their money into a market bank account, a Barclays deposit account or something. Okay, so we have to say, if the market interest rate was something, the coupon, this gilt, pays you £5. What is the price that I'm going to be willing to pay for it? Because therefore, what is the yield? That's the term yield, which is different to the coupon rate that you've got to work out. Okay, so I'll give you an example. If the interest rate in the economy was 5% and this piece of paper was paying £5, the investors are going to be willing to pay £100 for that piece of paper, because when they work out the effective yield on it, they can say it's £5 over 100, that's 5%. So that 5% there is exactly the same as I'd get in a bank account on the high street. So I'm willing to pay £100 for that piece of paper. Okay. Now, what if the market interest rate went up? The argument is it still pays £5, this piece of paper, so the investors are now only willing to pay £50 for the gilt. Okay, because when they take the £5, divide it by 50, the effective yield is 10%. That's what they could get elsewhere. Okay, so hopefully that makes sense to you. So when the market interest rate has gone up, the price has gone down. That's a key relationship. If the market interest rate was 2.5%, this piece of paper paid me £5. That's the coupon rate. The price I'm willing to pay is £200, because 5 divided by 200 is my 2.5%, which I could get in the local high street. So the relationship is that if the price of a gilt falls, okay, the yield or the interest rate on that gilt, the effective interest rate, will rise. So when the price has fallen, that yield has gone up, and if the price of the gilt rises, there it is, the yield will go down. So you've got to be able to explain that in the exam. I have seen multi-choice questions which give you a coupon rate and a price and say what's the yield as well. So you have to be able to work that out. Now, what's the effect then on the economy? So all you've got to say is that when the Bank of England, remember, demand these gilts from the bank, that's an increase in demand which causes the price of the gilt to rise. The effective yield will fall, the interest rate will fall, increases the demand for borrowing, therefore increases consumption and investment, which is linked to interest rates. Hence it increases aggregate demand and it raises the inflation rate back to the target range. So the first effect of an issue of quantitative easing issuing gilts is that the interest rate will fall. Okay. The second effect, what we've just talked about before, which is that if the Bank of England take these gilts, they demand gilts, they're basically increasing the liquidity of the banking sector, and that enables the banks to lend more. So this one here reduces the interest rate, which then should mean that consumers, investors, firms who want to buy capital machinery will come and borrow money. This one gives them the ability to lend out. So try and make that distinction. Now, finally, the third effect, quantitative easing will also create some more money, more pounds in the banking system. Therefore, there's an increase in the supply of pounds. Increase in the supply of anything reduces the price of the pound. That's the value, that's the exchange rate. That means export prices are lower, prices of imports are higher, AD is shifting to the right, and being the price of imports going up, that means it's going to lead to inflation as well. Okay, and that's quite an important thing to say at the moment, because the current inflation we've got in the economy is supposed to partly come from the excess of liquidity that there's been following the quantitative easing. That's what some economists argue. So, in summary, this is what you would be saying, I hope, is that the Bank of England bought the gilts, improved the liquidity, and that enabled the banks to lend more. That enabled them to, but firms were still reluctant to borrow. In evaluation, the ability to borrow and the wanting to invest in capital machinery is actually linked more to what they think is going to happen to demand next year, expected future demand. And so as they came out of the financial crash, there was a lot of excess capacity as well. And a lot of firms just said, we don't want to borrow, we don't need to borrow, we're not sure about the recovery of the economy. You could argue that now with COVID, are we certain about the recovery of the economy? The demand for gilts analysis reduces the interest rate, but as I say here, it's about future demand, not just the cost of borrowing. That is the thing that affects the ability or the desire of firms to borrow money to invest, and consumers, etc. And so you can question the size of the output gap. It was quite large after the financial crash, certainly. Third point would be that investors switch into stocks and shares. Okay, that basically what happens is that if the price of gilts goes down, investors who've got some gilts say, well, I don't want those gilts anymore, I'm going to buy stocks and shares. That means the value of the stocks and shares rises. The stock market rose in value, certainly did with quantitative easing in the early days, and therefore that increases wealth, and it's that wealth effect that then brings more demand for goods and services in the economy, and so that's where the spending came from. There were two effects really. One was stocks and shares, and the other one was housing. The housing market rose on the back of all this extra money, and some argue that that was existing assets. So, if you go and buy a share in a market, that's already there. The share is there. If you buy a house, it's already there. So unless it's a new built house, but there wasn't this increase in productive assets going on in the economy. It was existing assets that rose in value, and so quantitative easing wasn't really that successful. It will, of course, cause the increase in the amount of sterling in the market, and therefore the exchange rate will go down, as I've explained, but it's causing cost push inflation. Okay, so the fall in the exchange rate will cause the price of imports to rise. And so some people argue here that, and recently in the Financial Times you can read an article from the chief economist at the Bank of England. He's admitted quantitative easing may well have been a cause of stagflation that we are witnessing at the moment. So it's an interesting one to watch. It's still unfolding, this picture. It will benefit borrowers and investors in stocks and shares because they already hold those stocks and shares. If the value goes up, they become wealthier, therefore they're going to spend more, etc. So that will stimulate aggregate demand in the economy. But there are savers in the economy, and the fall in the interest rate might actually affect them badly as well. Okay, and lastly, this is something that we'll come to in the next video, which I'm going to look at the application of this and try and sort of guide you as to what has happened and what people are sort of feeling their way through, whether it's been successful or not. Is that people say quantitative easing worked in a crisis after the financial crash when the banks were having liquidity problems. It certainly saved some of the banks from collapsing, but it didn't really work to raise investment in productive assets. And so you can argue it had a positive effect in the short run by keeping liquidity going, but it didn't really have an effect, a positive effect in the long run. And so hopefully that gives you enough. Certainly if it was an essay, you'd be looking at 3 points: the liquidity, the interest rate, and the exchange rate point, and then questioning whether or not quantitative easing really helped or not. So in the next video, we're going to look at some data that's starting to come out and use that to apply our knowledge and see whether or not quantitative easing was successful or not. So hopefully that gives you a good background, and watch out for the next video.